So we are going to be looking at chapter 13. In chapter 13, the idea is how do we calculate the cost of capital? Before we can get to that question, we have to raise another question. What is capital? Capital in this context is the financing that the company uses to essentially invest in its assets and produce its products, goods, and services. So there are two sources of capital for a firm. Mainly, you have equity and debt. And then within equity, there could be two sub-sources, common stock and preferred stock. Okay. So the question is, when the company raises this capital, it has to, obviously it is asking general public to either buy its common stock, its preferred stock, or its debt. That means people who are investing with the company are investing expecting a rate of return. So what is rate of return to the investor? So rate of return to investors is equivalent to the cost of capital to firm. Not exactly equal, but equivalent. We'll see why it is not exactly equal later. So whenever the company goes out into the market and solicits money to finance the acquisition of its assets and the production of its goods and services, investors have an expectation that they will receive a return from their investment. So this return that the firm has to provide to the investors is essentially a cost for the firm. So thus capital is not costless, there is a cost associated with capital. How do we determine this cost of capital? First, for the individual components, common stock, preferred stock, and debt, and then for the overall firm. And we will determine the cost of capital for the overall firm in a manner that tells us what is the marginal cost of capital. So when we are talking about the cost of capital, most often what we are implying, it is equivalent to saying, what is the marginal cost of capital? Means what? It means what is the cost to the firm for the next dollar of capital that it raises. What is the cost to the firm for the next dollar of capital that the firm raises? So if it goes out and it has to borrow $1 or raise from the equity market another dollar, what will be the cost that the firm will have to incur, meaning what will be the return that investors will be expecting? So that's what we have to compute. And why do we need to know this? What is the purpose of finding out this cost of capital? Because if you recall from your capital budgeting, net present value, generally speaking, initial investment plus the present value of future cash flows for I equal 1 to t. So essentially what I'm doing, C1 divided by 1 plus R plus C2 divided by 1 plus R squared plus C3 divided by 1 plus R cubed, dot, 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 all the way till T. So that's the equation that we had used to calculate net present value. In this equation, there was one important input that we have not discussed so far. And that input is this rate of return, or this discount rate. At what rate should I discount these future cash flows? And the answer is that R should be equivalent to the firm's cost of capital. Meaning that for the next dollar that the firm is going to raise, how much will it cost the firm? Because that will determine where the firm is going to make that investment. If this cost is too high, then NPV is not going to be positive and the firm may not want to invest in that project. If this cost is low, NPV may be positive and the firm may want to invest in that project. So this cost of capital is called weighted average It's called the weighted average cost of capital, or WACC. This weighted average, and we call it the weighted average cost of capital because we recognize that capital is made up of different sources, equity and debt, and we are going to calculate cost of capital in a manner that provides us a weighting, an averaging of the component parts of capital. So we have to average, and the method by which we will do it is the weighted average method. So let's take a look at how this works. So this is the basic balance sheet. On the left hand side, you have everything that the firm owns. And on the right hand side, you have everything that the firm owes. So we use these capital sources, these sources of capital, to acquire these sets of assets. Now, we can see over here the mix between debt and equity is not uniform across firms. Apple has much lower debt compared to Southwest Airlines. So given that this capital structure, this mix between debt and equity, another way of describing that is we call it the capital structure of the firm. So given that there are differences in capital structure across firms, and for good reason, one of the reasons that Southwest Airlines has more debt than Apple is because Southwest Airlines operates in an industry that is more asset-based. So to take debt, the firm has to collateralize the debt. So there needs to be fixed assets that can be held as collateral against the debt. Apple, on the other hand, works mostly in an area that is based on intellectual assets, not so much physical assets. So thus its level of debt, because it does not have tangible assets to offer as collateral. So that's one of the reasons why their capital structures are different. And so we have to account for that difference in a way we calculate the weighted average cost of capital. So the weighted average cost of capital is what we are after. First, what is the overall understanding of the weighted average cost of capital? And there are two ways to look at it. What is the cost of capital when the firm is unlevered? What does that mean? It implies all equity. When the firm does not have any debt. And when the firm is levered, it implies mix of debt and equity. Mix of debt and equity. So for an unlevered firm, what would be the cost of capital? For a levered firm, what will be the cost of capital? So weighted average cost of capital would simply be the equity cost of capital when the firm is unlevered, when it is an all-equity firm. There is no debt, so obviously I don't have to consider the impact of debt. But if the firm is levered, and there's one more addition over here, and it pays no taxes. So for the first pass, we assume as if the firm is not paying any taxes, then the weighted average cost of capital can be written as the weight of debt times the cost of debt plus the weight of equity times the cost of equity. What does this weight mean? The weight means the fraction of the firm's value that is financed by debt. So that's our weight of debt. This one over here is the fraction of the firm value that is financed by equity. So that's our weight of equity. This is the cost of equity, and this is the cost of debt. So we need four pieces of information: the weights between debt and equity, and the cost of debt and the cost of equity. This is when the firm is not paying any taxes. This formula only works under this circumstance, when the firm is not paying taxes. So here we have a problem. The firm has debt with a book value of 10 million, but it is trading at 95% of that book value. It also has a book value of 10 million in equity, but it has 1 million shares that are currently trading at $30 per share. First of all, what weights should Kenai Corporation use? And what we should be using is market value. So $10 million in debt trading at 95%, that means the market value of debt is this is the market value of debt. Market value of debt, 9.5 million. 1 million shares trading at $30 per share gives me $30 million. So that's the market value of equity. So weight of debt is the market value of debt divided by market value of debt plus market value of equity. To be simple, I can just write this as D divided by D plus E. So D is 9.5. I divide that by 9.5 plus 30. So 9.5 divided by 39.5 would be 24.1, which is what we have here. So that's 24.1%. And this number, the weight of equity, there are two ways I can do it. One is just to follow this one, which is equity divided by debt plus equity, which is going to be 30 divided by 39.5, and you get 75.9. That's one way to do it. There's another simpler way to do it. Since I already have weight of debt calculated, and the weight of debt plus the weight of equity will always equal 1. That means weight of equity will be 1 minus the weight of debt, which is 1 minus 0.241, which is 0.759 or 75.9%. That's what we have. So there are two ways I can get to it. Either I can do them individually, or I can just do one of them, and the other one, whichever one I did not do, will always be 1 minus the weight of whichever one I calculated. So just keep this formula also in your mind. Similarly, you can calculate, work through this problem on your own. Now, when we get into the component parts now, so there are three elements that we have to look at. Two basic elements: first, equity and debt, and then within equity, common stock and preferred stock. So those are the three elements that make up capital. Preferred stock, common stock, and debt. So let's take a look at debt. So what will be the cost of debt? The cost of debt, RD, is essentially the yield to maturity on the debt. That's the market yield, because remember what yield to maturity is. Yield to maturity is telling us if I buy the bond at whatever it is trading at today, and then I hold the bond all the way to maturity, and I get back the face value, and in the interim, I get back all these coupons, then the return on my investment, and so this is the investment that I made, and these are the cash flows that I got back. The return on my investment is essentially what we call the yield to maturity. So again, going back to the idea that what is cost, what is return to the investor is cost to the firm. So this is the yield or this is the cost that the firm is essentially paying, but not fully, because debt is unique. It is a different type of a capital. So generally, what is return to investors is cost to the firm, but not fully for debt, for one important reason. The interest that we pay on debt is tax deductible. If you recall what an income statement looks like, you start with revenue, subtract cost of goods sold, subtract depreciation, that gives you EBIT, then you subtract interest, that gives you EBT, then you pay taxes, and that gives you net income. So, interest is being deducted. Interest is being deducted before taxes are being paid. So that's what we mean by that interest is tax deductible. Interest on debt is tax deductible. That means the impact of interest is what? The impact of interest is that it reduces tax liability. Because I'm subtracting interest over here, that means I have less in my EBT, in my earnings before taxes, and the taxes that I pay is a percentage of that earnings. It is based on EBT. So because of that, the impact of interest is to reduce tax liability. And that reduction essentially improves my net income, my bottom line. So thus the actual cost that I am paying on debt is not RD. It is RD minus RD times the marginal tax rate. So this is reducing the actual cost that I'm paying on my debt. So my net cost, taking RD common for my debt, is this one. It is RD times 1 minus TC, where TC is the marginal corporate tax rate. So given that, if the pre-tax cost of debt is 2.81% in this problem, you can think of this as the yield to maturity on DuPont's bond, and DuPont's tax rate is 35%. What is the effective cost of debt? Of course, the effective cost of debt RD is 2.81, TC is 35%. So effective cost of debt is 2.81% times 1 minus the marginal tax rate, or 1.82. So even though investors are getting 2.81% yield on their investment, the company is only paying a cost of 1.827% on the debt. So given this, debt has an advantage. Given the tax deductibility of debt, there is an inherent built-in advantage for debt. And by the way, this tax deductibility of interest, the fact that we are deducting interest before we pay taxes, this is simply because the tax code allows us to do so. Right? So because the tax code allows us to do so, there is an inherent advantage that we have for debt. Okay. So you can work on a similar problem like this to calculate the impact of debt. What is the after-tax impact of debt? Now let's look at preferred stock. Another source of capital that we have is preferred stock. Now if you recall, the price of a preferred stock is simply dividend divided by the discount rate, because preferred stock pays a known dividend and that dividend is paid forever. So essentially that dividend is constant and it is paid forever. So on a timeline, it goes forever. This is D, 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 and so on and so forth. Essentially, that's a perpetuity. And the present value for perpetuity is given by this. So now to calculate the cost of the preferred stock, I take the dividend and divide that by the price of the preferred stock, the current price of the preferred stock. So if a stock price is this, 66.67, and has an annual dividend, for preferred stock, the annual dividend will be known and stated, unlike a common stock where that dividend is unknown and never stated. So we will take the dividend, divide that by the stock price, and that gives us the cost of preferred as 5.25%. But for preferred stock, I don't have to do any tax adjustments because the dividends that is paid for the preferred stock comes out from net earnings or from net income. So it is paid after taxes have been deducted, unlike interest, which is paid before taxes have been deducted. So that's the key distinction. Now, how do we determine the cost of common stock? There are several ways in which this can be determined. The two most common method is to first use CAPM, which we had learned earlier. So for CAPM, cost of equity is the risk-free rate plus beta times the market return minus the risk-free rate. So this is what we had learned earlier. So we just simply directly apply that, and that gives me cost of equity for the stock. So here is an example. If beta is 1.37, the yield on a treasury note is 3%, so that's my risk-free rate. And the market risk premium is 6%. Market risk premium means it is the difference between the market return and the risk-free rate. So then it is 3% plus 1.37 the beta, so this is RF plus beta times RM minus RF. So RF is 3%, beta is 1.37, and this whole thing is 6%. So that gives us 11.2%. So that's the rate of return that stockholders are expecting from this company, and that 11.22% is the cost to the firm, cost of capital to the firm. There's a second method by which we can calculate the cost of equity. If you recall, for a constant growth stock price is D1 divided by R minus G. So in this equation, I can isolate R. R is going to be D1 divided by price plus G. So that's just inversion of that equation. So D1 divided by price plus G. And you know what D1 is. D1 is dividend next period, which is the current dividend times 1 plus the growth rate. So this part you need to keep in mind. This is D1, not D0. Divided by the stock price today at time 0. So on a timeline, this is the stock price today, and D1 is expected to be the dividend in year 1. So keep that in mind. Plus G is the rate of growth. So we already learned how to what the formula is. All we are doing over here is just inverting the formula to calculate the cost of equity. Again, this is the expected return that investors in the common stock are expecting from their investment in this stock. So what is returned to the investors is cost of equity to the stock, to the firm, is the cost of equity to the firm. So here we have an example. A firm has a growth rate of 7.9%, that's our G. Its expected dividend 1 year from now is 180, so that's already stated in D1 terms. And this current stock price is 57.66, so that's our P0. Just a matter of substitution, 1.8 divided by 57.66 plus the growth rate of 7.9% will give us 11% as the cost of equity. So we can see that 11% is slightly different than what we had when we determined cost of equity through the CAPM, 11.22. Both for the same firm. Both for the same firm, DuPont. So it is not necessary that the CAPM method and the stock price method both give us the same answer. So if you are an analyst or a firm manager trying to determine which of these two numbers you use, my suggestion is that you take both numbers and you average them out and use the average of these two numbers as the input for your cost of equity. Okay, so you can work on some of these problems, very similar type problems, you can work on them. So the last thing is, then what is the weighted average cost of capital when we are taking into account the impact of dividends? So weighted average cost of capital will be the weight of equity times the cost of equity. This is for common stock. If I have preferred stock, then the weight of preferred stock times the cost of preferred stock, if I have it, and then plus the weight of debt times the cost of debt multiplied by 1 minus the marginal tax rate. So this is equity. This is the weighted cost of equity. This is the weighted cost of preferred equity. So this is common equity and preferred equity. And this is the after-tax after-tax cost of debt. So the three components now all taken together. If there is no preferred stock, then of course this will drop out. And if the firm does not pay any taxes, then this will simply be WERE plus WDRD. But this is the general formula. Then accordingly, you have to make adjustments. Also note that if you do have preferred stock, then WE plus weight of preferred stock plus weight of debt will equal to 1. The three weights will have to always equal 1. This is what weighted averaging averaging using weights or weighted averaging actually does or is used. So this is inclusive of preferred, and the second one is when we are not necessarily thinking about when we do not have preferred stock. So let's take a look at a quick problem over here. The market value of DuPont's common stock, preferred stock, and debt were given. Market values have been given. Its total value is then the addition of these. This is the total value of the firm. Given the costs of common stock, preferred stock, and debt, as we have already computed, what is weighted average cost of equity, weighted average cost of capital for DuPont? So 12.6 is the cost of the cost of equity, RE. This is the weight of equity. Here is the cost of preferred, and here is the weight of preferred. Weight of preferred. Weight of preferred. This is the cost of debt. This is 1 minus the tax rate, and this is the weight of debt. And of course, the weight is we take the proportion in equity divided by the total capital for the firm. So expected return, another example, expected return on target's equity is 11.5. It has a yield to maturity on debt as 6. So this is RE, this is RD. Debt accounts are 18% and equity are 82%. So this is WE and this is WD and this is my corporate tax rate or marginal tax rate. So now it's just a matter of straight substitution into the equation. RE times E, RD times 1 minus tax rate times D. So this is RE times WE. This is RD, 1 minus the tax rate, and this is WD. And that'll give you 10.1%. Okay, so I have completed up to section 13.3. The last thing I want to do is how do we use this weighted average cost of capital to value a project? Okay. The way we do this is essentially we calculate what is called the free cash flow of the firm, and we divide the free cash flow of the firm or free cash flow of the project with the weighted average cost of capital as the discount rate, and that will give us the value, or what we call the levered value, meaning the value of the firm that is inclusive of debt. Levered value means it is simply the value of the firm or the value of the project, depending upon what the cash flows are, project for a firm with debt. It has some debt capital. So let me just go quickly and show. So this is an example. Suppose Starbucks is considering introducing this cafe mocha with 0 calories, and all the detail over here. The cost of bringing this product to the market is 280 million. So that's the cost up front. And Starbucks expects the first year incremental free cash flow to be 80 million, and this will grow at 5% per year forever, should Starbucks go ahead with the project. So the obvious question is, what's the net present value? The weighted average cost of capital, we have to calculate the present value using weighted average cost of capital and then subtract 280 to get us to this point. So our initial investment is 280. This is like our I0. In this case, it is written as FCF0. Then what are all of the future cash flows? All of the future cash flows are going to be growing at the rate of G. So the projected cash flow in year 1 is 80 million divided by R minus G. We subtract 280 million. This is positive, so we accept the project. So this is a practical example of how weighted average cost of capital is used to determine acceptability of project. Similarly, other problems. Okay, just a quick recap on how this FCF is calculated. This is very similar to what we did before, but I want to recap this over here. So we start with sales, subtract cost of goods sold, subtract this, that gives us gross profit. Subtract operating expenses and depreciation, that gives us EBIT. Then we pay our taxes on it, we subtract the taxes that we pay, that gives us what we call unlevered net income. Why is this unlevered net income? Because we have not considered the impact of interest over here. We have excluded interest from our calculation. That's why it's called unlevered net income. Now to get us from unlevered net income to FCF, what do I have to do? I have to add back the depreciation, since it's a non-cash charge. I will subtract any capital expenditures if I paid for any improvements of plant, property, and equipment. And then I will subtract any increases in net working capital. And we know what the definition of net working capital is. In an earlier chapter we saw this. It is current assets minus current liabilities. So we have to take into account increases, year by year increases in net working capital. If there is any, then we will subtract that. And that will give us what we call free cash flow. Once I have the free cash flow, then I just plug it back into my model. If I have them over an extended period of time, I just extend it out and then I plug it in. So essentially, here is my investment in year 0. These are my future cash flows. So the present value of these cash flows minus the initial investment will give me my net present value. But in taking the present value of these future cash flows, I will have to discount them at the weighted average cost of capital. That's the key. Because when I include weighted average cost of capital, I am already factoring in the impact of debt. I excluded debt over here, but I factor debt in over here when I calculate my present value using the weighted average cost of capital. So, value of the levered firm is going to value of the levered project. We take the cash flows based on unlevered income, then we divide them by 1 plus r, 1 plus r squared, 1 plus r cubed, 1 plus r to the power 4. So this r that we are using over here is the weighted average cost of capital, which is inclusive of the impact of debt. Then from this, I subtract the initial investment of 28.34. That's positive, check mark. We accept the project. So that completes our discussion on chapter 13.